Boom, boom. Welcome aboard. Hey, it is I, your boy TJ, and it is another day where we talk about property and tax and property. And if you've never been here before, this is what we do all the time. And it is to benefit you and I. My name is TJ, Taurai Jack, and welcome aboard to my co-host, Lebo. How's it going?
How's it going, TJ? How's it going, guys? My name is Taurai and Lebo. I'm the founder and CEO of Biz House. We're here to talk about property and taxes and property. That's where we play. That's our space, the way we play in. So stay tuned as we unpack some interesting topics.
Awesome stuff. Lebo, you've been in the business for the last couple of years. In the property space, and but before that you were doing you were specializing in finance, particularly in tax, and this kind of like gives you the right for us to be talking about taxes. And you know, a lot of people have been asking me, TJ, how does Lebo get to know all of this? And I just wanted us to cover that basic in terms of how do you come to talk about property taxes, man?
All right, I hold 4 qualifications in finance, and of which the highest of those qualifications it's an honors in taxation. So I'm also a member of SAIBA, South African Institution of Business Accountants. So I'm a business accountant, and on an everyday basis, I mean, I'm into property. I do property deals. So even in practice, practically, I also apply some of these advices that we give on this platform. So I am actively practicing what I'm preaching, and I have the knowledge and the expertise to be talking about this topic.
Awesome stuff. Thanks, Lebo. I think, you know, I got exposed recently to a book by the called Fake. And Uncle Bobby, as I call him, Robert Kiyosaki, wrote that book. And you speak about something there, Lebo, to say, I'm an active investor. I practice what I talk about. And in that book called Fake, he literally talks about be careful to be taught with fake teachers. And fake teachers is people, they are preaching something else or teaching something else, but when they turn their back onto something else, they are completely doing something else. So people, for instance, they say, coming through to seminars, but for property seminars and things like that. But they don't do any property at all.
Yeah, true.
100%. Okay, cool. What are we going to be talking about today? We are going to do a deep dive into expenses. Deductible expenses. Lebo speaks about them. He says that SARS, they have given us an opportunity to say, hey, you can actually dictate A, B, C, D, and out of that, we are happy to, you can claim it back, and all of these things are there. Now, I've received a couple of questions, and I thought maybe today, let's utilize today as an anchor conversations of some of the questions that you have asked. So we see your questions and we want to dive in. Lebo, the first question that I want to ask you, in our previous video where we were talking about deductible expenses, anyway, what is deductible expenses? You go for it.
So deductible expenses, it's those expenses that SARS allows you to deduct from the income that you've received. So you have your sales, you have your cost of sales, you have your expenses, your deductible expenses that are allowed, things like your salary, admin, accounting, legal fees, operation expenses. So all of those rates and taxes, those are the expenses that you are paying that SARS allows you to deduct before you get to your net profit before tax. So your net profit before tax is where SARS comes in and say, look, this is your net profit before tax. This is where we're taxing you. So this is the amount that is left off after you've earned and spend the allowed expenses that we give you as a relief, as a tax relief, to say, look, we know that you're in business to make money, so let's help you, with your expenses, to say, look, let's allow you to deduct certain expenses. Then only when you get to your net profit, we can tax you there.
Awesome. Someone asked me the question that in the event that I can claim for some of these deductible expenses, and this person here, I don't know whether they were asking in their personal capacity, in a company capacity, but we're just going to take it that they were just asking in general. And maybe, Lebo, you can cover it both from
Yes.
a personal perspective and a company. And the question that they asked was, if I claim back, do I get the money back to me in my back pocket?
So, so it depends, right? So if you claim back tax, so that depending on the amount of tax that you've already paid to SARS, remember SARS is the receiver. So tax was implemented so that they can collect money from whoever who's making money in order for them to run the country, right? So depending on your tax that you've paid over the tax period. So let's say you are now submitting for 2019, 2020 financial year, and you've paid R1 million, but when you do your tax submissions, you find that you were supposed to pay 600,000 as opposed to R1 million. So that means there's a difference of 400,000 that you can claim back from SARS, and they'll pay it back into your account. So some of these tax deductible, it's just for SARS to say, let's calculate how much is due to us. Like for instance, in terms of companies, so you do two submissions. You do your preliminary submissions, of which is your, forgot the term, but you do 3 submissions. You do the one in July that is due in July. You do the one in February, and then you do the one in March. So so it's like the one that you do in July. It's like you are estimating to say, look, this is how much I'm going to make this year, and then you submit that, and then you pay that to SARS. And then it gets to the fund to the end of the year, you find that you've made way less than what you have predicted that you would make. Then you can claim back from SARS, and SARS will pay you back that money. But now, if you've made more than you've estimated, then you are going to pay to SARS.
100%. I think that makes a lot of sense. And even to me, to a guy like me who doesn't know anything about taxes, I think I get it, right? So the next thing that I want to ask here, Lebo, is that we are always having this conversation. So how do you know which structure you should be utilizing? And we have said to, many of our conversations, go out there and make the informed decisions by checking out what works for you. But in particular, 2 things, Lebo, that we want to zoom into. If you're an employee around tax deductibles, as a company around tax deductible, and it means that you're buying in your personal capacity, or you're buying in a company, or you're buying in a trust. How are tax deductible? How do they benefit me as the individual? Because I could be buying in my own company or as an individual. Where do I get the most benefit here between the 3 structures?
I think it all differs. It all depends. But your personal capacity, you have the most limited tax deductible allowances given to you under your individual capacity.
Right.
Then in terms of, so that means that in your personal capacity, your tax deductibles are limited to a certain degree. And then at the same time, you are taxed the highest tax percentage in South Africa. So your income tax under personal capacity, it's up to 45%. And when you look at the companies have the best or the highest tax allowables in our tax laws. So you get the most benefit from that, and they are only taxed up to 28%. So you can't be.
And Lebo, I want to jump in there. You're saying tax allowables. So, the new term for us that you're talking about there, it just means that it's those things that you can claim back. So, but here we're just talking about a wider range of things compared to when you're an individual, you probably have 5. But in a company, you kind of like have maybe 20.
Yes.
Okay.
And then, so you have different tax allowables, tax expenses that are allowed by SARS that are deductible, tax deductibles. You have the highest in terms of a company and a trust as well. So a trust is the second highest taxed person in terms of our tax laws. But the good thing is that the money that your profits that you pay to your trustees or your beneficiaries are also tax deductible, and then they are taxed at their own personal capacity.
Right.
So yes, so in terms of the best structure, I always advocate for a company, then followed by a trust. So depending on how you want to structure your things, your goals, your needs, your aspirations, where you are, where you want to get to. So between the trust and a company, then it will be advisable to have your options weighed around those two to see how you can benefit from our tax deductibles.
I got a call from one of my students that I coach in the property space, and they said to me, TJ, I am speaking to my estate agent, and my estate agent is saying to me, don't worry about the transfer fees, because even though it's a high cost, you can always claim it back. But if I'm calculating this deal, the deal is not making sense. But the estate agent is saying to me, well, I'm going to get back my money anyway for the transfers. And if I deduct this, the deal is going to make sense. But I'm now thinking that I'm only going to be getting my money back like at the end of the year. And I thought, I think maybe I need to be asking Lebo here, because at transfers, whenever we are buying a property, nobody runs away from a transfer fees. Nobody.
No, you can't avoid it. Yeah.
Right. Now, how is the transfer fees, or how should we be able? How can we best manage the transfer fees to our advantage? Because we always want to have liquid on the table, right? So in terms of me being as an individual, I'm buying this property here, and now I need to be paying this 200,000 transfer. Can I deduct it as is it applicable? Is it one of those things? And when it now compares to into a company, and I'm buying this in a company, how best is it also a deductible amount? Expense.
Yes. Yeah. So in terms of on your personal capacity, then it's a bit tricky, right? Yeah. If you are buying your primary home, forget the tax benefit. You're not gonna get it.
Right.
Under your personal capacity.
I like your smile. Like, forget.
No.
Like you've lost it.
Yeah, it's your expense. It has nothing to do with SARS.
Yeah.
But when you're buying an as an investment property, it is tax deductible. So you can either claim it when you are doing your normal tax submissions,
Right.
or you can claim it later when you are accounting for your capital gains tax.
Right.
So it's two ways. So you can either account for it at when you're doing the actual deal on that particular year, you can include that expense as a tax deductible, or you can just leave it for later, and then when you are selling that property in terms of capital gains tax, then you can deduct it from there under the individual capacity. Under a company, transfer costs are treated as legal costs, so it is a deductible expense under a company and also under a trust. So it's a straightforward tax deductible item under a trust, under a company. So there's no complications, there's no issues when it comes to it. It's straightforward. You spend 200,000, you deduct 200,000 as an expense. You spend R1 million in transfer fees and bond registration fees, you deduct that. Those are legal fees. It's an item called legal fees in the accounting, so you just account for it as legal fees, and then that's about it. Straightforward.
So here's another thought, and I had a debate here with my accountant at one point, and I was saying to them, look, my buying cost here includes my legal fees.
Yes, true.
So I'm of the view that my transfer fees, because each time we're buying a property, right, you are going to have a heavier number in terms of transfer fees, and then it's going to translate into an expense. So which means that if I'm starting off, I am continuously spending a big amount of money, so my business is not going to be profitable for that longer time, right? Because I need to chase that transfer fee. And I was of the view that, no, hold on, it's not an expense. I think it's a buying cost, and it needs to sit in. If I've bought my property for 1 million, and now I have transfer fees of 10,000 Rand, so my buying cost is 1,010,000 Rand. That's my view. What's the correct way there?
So when you are doing capital gains tax, for instance,
right?
When you're doing a capital gains tax, your legal fees are also included in your buying costs. So in your cost for the property. So they say you bought for R1 million, you spend 100,000 in legal fees. So that's 1,100,000. And then you spend another 200 in improvements, building improvements. So now your cost is now sitting at 1.3 million, as opposed to the million that cost you to actually buy the property. So it is included in that cost of your property when you're doing a capital gains tax calculation.
Right.
So it is your expense. It is supposed to be included in the asset price that you are declaring when you're doing capital gains tax. But when you're doing your normal income, because remember, income tax is different from capital gains tax. So capital is the capital that you put in the actual asset minus the proceeds when you're selling the actual asset. Now, when it comes to income, we're saying, look, you've received R1 million into your account. Then what have you paid that is tax deductible according to SARS? So then we list all those line items in terms of income and expense. So it's an income tax, so they look at income and expenses.
100%. I think for the first time there, I was right with things. So, and I'm going to ask this question, but it's actually a question that I was going to ask a little bit later, but I just want to tie it in here for the transfers. So let's assume that we bought this property in 2015, right? At the time of recording here, we're in 2020. And I bought this property in 2015, and I am only coming to be aware of all of these things that we are talking about now. Can I go back, Lebo, in retro to 2015? I'm like, hello, Mr. SARS. I forgot to include the fact that I bought this property as an investment, and I would like to include expenses 1, 2, 3, and we are now in 2020. How does that picture look like? In my mind, I think with the little that I know of tax, I'm like, let's go ahead. I don't want Mr. SARS to come and knock on my door and say, hey, Mr. Jack, I'm happy to just go ahead. But this is just coming from people's stories on the streets, on the braai stands, you know what I mean? But I want to hear it from you. You are more closer to the detail around of what happens here. Can I go back into 2015?
Yes, it's very possible to go back to 2015. But you must bear in mind that when you do go back, because you have already submitted in 2015, right? That tax year is closed, is calculated, you've moved forward. Now you want to go back and reopen it and include certain expenses into it. So you're going to do a resubmission. And when you do a resubmission to that, that means that now you're going to open, first thing first that SARS is going to do, they're going to review your resubmitted tax return.
Right.
And ultimately, most likely, you're going to open yourself up for audit. Yeah. And we all know what happens when SARS comes to audit, right? They scratch every surface. So when you open yourself up, if you have nothing to hide, by all means, go ahead. If you are sure of your accountant's story, by all means, go ahead and reopen it. But if you're unsure of if you've declared, because there's a lot of people that under declare, of which it is tax evasion, it is illegal. So that means you are also opening yourself up for a possible legal action against you. So rethink carefully, have a look at your tax matters before you can revisit that. It is possible. If you can, I mean, it's advisable to go back and say, hey, I've paid more than I was supposed to. Bring back a little that I've paid over that more than what I've paid in the previous years. But then again, you're looking at SARS is in the business of collecting money, not paying people. So, so when you pay SARS, it's okay. Yeah. When you now want money from SARS, now it becomes a problem.
Sure.
Because they want you to make sure that whatever you're claiming, it's true. Right. And whatever you're claiming, it's also what you are supposed to claim. They want to look at the whole financial year and possibly even go back. Now you even open yourself up to have all your tax years reopened for them to scratch the surface to see if what you're claiming, is it correct, or did you overstate or understate in any other financial years?
I feel like this statement here that I'm going to say, Lebo, you know, my boy is going 12, and normally I say to him, you need to tell the truth all the time, yes, even if it gets you into trouble.
Yes.
And I'm sitting here, I'm like, so should I resubmit to SARS or not? But here, I think the pinnacle of the conversation here, especially to the scenario, is you need to be working very closely to your accountant, your tax guy. And if they're of the view that you need to resubmit, and they are confident within the paperwork that they've put together for your life and for your business, then that's the right thing to do, right?
100%.
Because even if you are to hide stuff, it's going to catch up with you at some point, isn't it?
Yes, 100%.
Right, so better correct it before they come and knock on your door, because then there is some form of, I mean, since they're not difficult, they just want stuff done in a proper way, in the way that they have governed. So we need to follow those processes.
100%, 100%.
A follow-up question to that, Lebo, is, I think we took the assumption that this person had submitted in 2015, 2016, so that it means that they are updated, right?
Yes, yes.
But the other thinking that I want to take there is maybe this person hasn't actually submitted from 2015 up until now.
We actually have a lot of those. Yes, yes.
Which is a reality in our communities. A lot of people are like in that position, isn't it?
Yes, 100%. So we have a lot of people that are in that position. I think over half, 50% of people that are tax registered, they're non-compliant in terms of our submissions. They're not up to date. So if we're taking a scenario of someone that hasn't submitted from 2015,
but Lebo, I think SARS has become clever now, especially for us guys who are in the property space, because at every new buy, SARS wants to get involved to see whether your affairs are up to date.
100%.
Not unless you're a cash person, you're just buying cash. But I mean, there's not many people out there. I'm only starting to test now how to buy cash. But for me, I've always been utilizing the bank's money. So for that reason, the bank wants to see your affairs up to date. SARS wants to see your affairs up to date. And out of all of this, it means that you can't actually do your business.
Yeah.
Sure.
Yeah, so if outside compliance, I mean, we all want to be compliant and follow the rules and follow the laws so that we don't find ourselves in the wrong side of the law. And SARS is, and if you are in a position and you say, look, Mr. SARS, I think I've made a mistake in 2015. I want to rectify it. The only thing that they're going to hit you with, it's just interest and penalties of whatever you've missed. If you there was any amount that was due to them. Okay. So and if in a case where you haven't submitted, for the past 5 years, the first thing that they're going to hit you with is penalties, non-submission penalties.
Right.
And then if you had an amount due to SARS from 2015, then there's interest on that amount to this date. So hence it's very important for us to always keep our affairs up to date. So that we can avoid unnecessary expenses, because they're looking at from a point of, look, I could have collected R1 million in 2015, but because you thought you were clever, you didn't give me money that is due to me, which is R1 million. Yeah. So now for withholding my money, now I'm going to hit you with penalties for non-submission. I'm going to hit you with interest on the money that is due to me. It's my money, but you sat on it. So I'm going to hit you with interest over the years so that I can make up for my loss that was due to me. Yeah. So
which is fair business practice, right?
It is.
The question though maybe is, how hard do they hit you? Are they machoneso, loan shark in terms of interest? Is it dependent on the person? How high of a high risk are they?
I think they have a standard. They have a standard interest that they charge.
Sure.
And to your worst case scenario is when they charge you per day on the for each. Like for instance, when it comes to vet submissions, I know they're very strict when it comes to vet submission, because vet is not your money. That is strictly SARS money. You're not involved anyway in vet. You collect the one that you issue, and then you claim the one that you paid. Right. So the difference you need to pay to SARS. That is not your business is just to submit to them and give them what is due to them. So that's their money. You're not involved anyway in that money. So with that, I know for every day that you're not paying them, there's interest accumulation. So if you draw a statement today and you pay that amount tomorrow, the amount is different tomorrow, then you're gonna have to draw a new statement and pay on that particular day. So they hit you with an interest every single day.
Right. I'm also aware that SARS is not the big bad brother. You can go through to your next for as long as your stuff is in order. I've had an experience, someone who was very close to me, and they had an accountant. They were called into the office of SARS, and the beans were spilled. It was everywhere on the floor. And SARS just said, well, this is it. This is how much you need to pay. From now on, your affairs are good, so you're good to go. But you owe us 500,000. And this 500,000, you can pay, because you earn like this, you're going to pay us X. And they came up with some kind of a plan, and that plan was followed, and that 500,000 was, paid for. And I think this is what SARS is looking for. They're just looking to collect what belongs to Caesar.
100%. I think we should take this, because we calling SARS our partner, right?
Right.
So for me and you, we are married. We have partners.
Right.
So take this as a form of partnership in terms of your marriage. You're supposed to be transparent with your partner. You're supposed to be fair and do things according to order. So, but once you start cheating,
no, you only show them what they need to know.
Yeah, exactly. So once you start cheating, then there's a problem in that partnership. So, and obviously, when there's a problem, there's consequences. Someone must suffer the consequences of those actions.
I think that's a good analogy there, Lebo, that you bring in there. And I think many a times we divorce ourselves from that and just put it like it's a big brother and they are there to slay me, and not knowing that actually, look, this is a symbiotic relationship. It's a give and take, give and take, give and take. Yeah, I like that. Once we are concluding, Lebo, on the deductible allowances, right? So I just want to ring it all together. As an individual, you do have deductibles. As a company, you do have them, but they are more. As a trust, just like as an individual, the trust is very similar as a trust in terms of being an entity. The taxation amount there is much higher, and you have more leverage within a company in terms of from what is deductible. Yes. And for that reasons, there's certain things that are actually predefined. You can just literally tap into it. And if you're working very closely with your accountant, bookkeeper, accountant, and your tax guy, it's very easy to clean up the mess. Can I call it that?
Yes, it is. It is a mess.
Clean up the mess from the past and go through to the authorities and sort out your affairs and start living in a cleaner space so that, you don't have anything to worry about. But
100%.
If you're already doing it now, get a little bit closer to your accountant. Like, for instance, in my team, Rita is very, very close to our accountant. I think they've got every weekly checkups on what's happening. And at the back of that, I have many conversations with Rita because she plays the CFO role in my business. And the thing there is, Lebo, you speak of having frequent touch points with your tax guy, with your accountant, even though yourself you have practiced before.
Yes.
And why do you do that though? You could practice it on your own.
I think the easiest way to say it is, if you are a jack of all trades, you'll be a master of none.
Right.
Yeah. So so my business now, it's property development and investment. So that's where my focus is.
Right.
Another thing is freeing up my time as well. So if I free up my time from doing tax matters, then I'm able to focus on what is important, which is the core business of my business, of which is property development, rentals, and investment side of things. So I can focus on that and grow that while my tax practitioner takes care of my tax matters. Yes, from here, from time to time, we'll touch base, we'll talk about it, we'll discuss our strategies. I'll give my input. And another thing that is most important is there's updates, constant updates in terms of our tax laws and our tax matters. So because they are practicing actively in the tech space, they keep themselves up to date of the new information, the new tax laws that are coming up, the new adjustments, the new tax cases that have been concluded. So they can keep up to date in terms of that, and I can focus on being up to date in terms of my business. And then we'll have a chat where they update me of the new things that are happening in the tax laws. Then in that way, I'm always up to date with when it comes to my tax matters and my business.
Boom! You heard it right, ladies and gentlemen. And that concludes the show for today. I just want to thank Lebo for being here with us today. And we've been talking about property and tax and property. And we're signing off. You want to sign off?
All right, guys, take care. Have a good one.
Yes, God bless. Goodbye.